Hello, another episode of The Circuit.
Greetings, programs.
Programs, AIs that are listening to this, AIs that will someday listen to this and then summarize it for our readers or listeners. Since I was just playing with this crazy solution called Chat YouTube, and I put one of our videos in there, the I put the semiconductor power players one, and I just started asking it questions, summaries. What did Jay say about this? And it's freaking worked. I couldn't believe it. Like summaries of videos, unbelievable.
We can have the robots do the podcast, and we can just go sit on the beach and sip
That's right.
umbrella drinks.
Ben's thoughts, Jay's thoughts on X. Train the AI on Ben and Jay. Okay. So one of our most popular episodes was our earnings preview, which I think because we have a number of investors, hello to you, who we speak to regularly that listen to this. But it piques my interest because you and I have a lot of conversations on both sides of the pond with technology companies relative to their investor relation strategies, with investment funds on the buy and the sell side as they're analyzing said companies. And we've talked about this before. It's interesting to sit in the middle of these two conversations. And I know that we hear things from the street that they don't tell the companies, and then we hear things from the companies that they don't tell the street. So it's an interesting dynamic. So I thought in this discussion, let's sort of unpack a couple of these things that we think are interesting. Like one, let's also look at this from what's interesting, what matters to investors when it comes to semiconductors, because it's different. Like my conversations with semiconductor investors is different than what I have about Dell or Apple or Microsoft, and it's a very, very different formula. And then also, let's look at this from the perspective of the companies who are sitting there always saying, my investors don't understand me. They don't get it. We're not just an X companies. Like it's just an interesting back and forth. So that's how I think today would be a good overview, looking at it from that perspective.
That makes sense. I just want to add, just to be clear, things that the company tell us that they don't tell the street. We are not going to discuss any of those
Correct.
today.
Right.
All
No.
publicly available information.
Yes. And obviously, there's fiduciary duty reasons that things don't cross those two ponds. Okay, so let's start with sort of the kind of investor side of things. I'm sensitive to what I think is an interesting problem for particularly the sell side, and I think part of this speaks to why there's a bit of a disconnect. The company saying we feel misunderstood, and then said investment company having a fairly sometimes rigid model on either the spreadsheet and or product market expertise. But a lot of sell side bankers cover, I would say, the average maybe 24 companies, tickers. That's a lot to cover. Like it's really hard to give any company really what they deserve or what the IR team believes they deserve in coverage when you're covering that much content and trying to update your models, trying to have conversations with their executive teams. It's just like I'm sensitive to how hard that is. Like they just don't have enough time. They don't have, and there's great companies that I've asked, like, "Hey, are you going to cover so and so semiconductor company? Their multiple is ridiculous. They're going to and they're like, I just don't have time to do it." And so I'm sensitive to that as a problem statement. Number one, that the sell side faces, and to the degree that I just don't feel like a lot of companies and their IR teams understand that dynamic about how difficult that is for their investors to truly cover them in really any meaningful way.
Yeah, I mean, I think there's three stakeholders here, right? There's the company, there's the buy side, and then there's the sell side. And even within the company, there's the IR team who typically should have a feel pulse for the street, but then there's the executive team who aren't, they have real jobs, so they don't necessarily know up to the second what investors are thinking. And so you start pulling apart those groups, you start to understand some of the dynamics, right? Ultimately, we live in a capitalist society, so the shareholders, the buy side, are top of the pyramid, And even within the buy side, there's two distinct groups, right? There are the generalists and the specialists,
Right. Right.
right? And like people who are specialists in semis, they tend to really know their stuff. I'm often more than me, really smart people who really know their stuff. But you talk about the sell side analyst having to cover 20 stocks. Even a specialist, tech specialist or semi specialist on the buy side is covering 100 stocks. Um, and so the buy side, when it works well, the buy side can lean on the sell side, the research analysts, to help them with stuff, right? And so, but then you're right, the sell side analyst, it's very competitive. It's not a fun business. I used to work there. It was a great job, but it's terrible business.
Hmm.
They're under, all kinds of time pressure, and they have to cover 20, 30 stocks, half of which they had to cover because their management
Yep.
told them to.
Yep.
Um, and then within all those boxes, there's varying degrees of competence and skill and will. So yeah, it's a tricky problem. But I certainly agree. Like I've worked on the sell side, and then went and worked inside a company doing IR, and there is just it's like through the looking glass, different universe. I'm in the upside down.
Yeah.
I won't say which one is the upside down with the evil demons, but one of them
Right.
is the
Right.
upside down.
Well, and it's interesting too because even with a lot of the, like you said, the specialists that I talk to, sometimes it comes down to like, is this a technology conversation? And I'm talking specifically about semiconductors, right? Like, is this something that you need to know the nitty gritty of transistor design, architecture design, process roadmaps, etc., or is it the market, right? And they're focused on a market conversation of, I've sized this market. I believe this is the TAM. And then to the degree that I believe X number of players or one or two players are well positioned for that TAM right within my thesis. So I've seen it from there's a technology product thesis, then there's a market thesis. I don't often see those two things converge in one sort of form of an analysis. But I think that's again why said investors consume a numbers of pieces of content, right? They don't live in holes and only consume their own thesis. They look at sell side notes or they look at colleagues' content, etc. But I do think it's interesting that is your approach. Do I have a fundamental belief in this company's product roadmap and the business of that, or the market opportunity and how positioned they are in that as sort of two tracks that again often don't even get communicated well from the technology company side. It tends to be like, oh, you should love my technology because it's amazing. I'm an engineering company, and so look at all the things I could do. Not tying that to market TAM, right, or the broader thesis that's being thought about them when it comes to their specific technology.
Yeah, I think that's very accurate. Is the company, the people on the company side tend to focus on what makes them special and what makes them different because that's what they're doing every day. Um, and they don't always understand that what parts of those are important to convey to the street. And by contrast, the street, if you talk to any investor, I mean, they good investors can summarize a stock in two or three sentences,
Yeah,
right?
yeah,
And I think that, it's like, oh, this company is really good in this market. It's number one in this market, but the market is shrinking. I'm gonna sell that stock,
right.
right? That's sort of like they have to work very hard to condense all that knowledge, and they look at things very high level strategically. Well, then you go to the company, and the company says, well, yeah, the market's shrinking, but we have this new product, and the product is going like this, and like there's all kinds of like behind the scenes actions taking place, um, that really don't matter to the street and are very important to the company because it's what the people at the company are spending all their time on, but don't matter to the street because they are far in the future. They're very small to earnings. And I think sometimes that condensing process, uh, leads to a little bit of groupthink on the buy side. Um, Sometimes,
Yeah,
and which will occasionally offer up opportunities. Like, oh, everybody on the street is missing this, right? And
right.
I think that's where that's a good opportunity. And for companies to sort of convey it, but they have to understand that like the stuff that they spend 24 hour, 12 hours of working days thinking about is 10 seconds in an investor's mind.
Yeah, that's a great, well put. And the other thing I think is sort of underappreciated from your casual pundits, and then to some degree the IR teams. And if I was an investment banker, this is exactly how I would think about it. So I don't fault the process, right? But essentially, they're looking at, in my calendar year, I'm managing X amount of money, and in that calendar year, I want to exit this year having had some increase to my portfolio. So therefore, you as a investment, from an investment thesis standpoint, will have both a short term picture. I like this stock this year, but also a long term picture, right? What are
Right,
my
right.
stocks that are going to grow 5 years plus? But that's like, and just to put a very specific example on this, this is why Intel is challenged as a stock. No one believes, even if you believe Intel is going to be great in 5 years, it's not going to make anybody money in 2023. So there's the reality of the short term. I've got $1,000, right? Let's just use it that way, and I need to make money on it. Who am I going to put my stocks in? Intel might not be one of them, right? And so that's why I think the short term plus long term perspective just gets underappreciated when you think about it from a money making standpoint.
Yeah, it's always a bad sign when you walk into a company or you walk into a CEO's office and there's a live ticker of the share price, right? Don't worry about it. Just don't worry about it. You have a business to run.
Yep,
Don't worry about the share
that's
price.
that's that's exactly true. Um, what when you did this, I think this is just sort of helpful from two things. One, because I have this conversation with different sides of the investment houses as to just how do they get ideas um, for content. This is a sell side point too, right? How do you just you're looking for something to say that someone else hasn't already said, and to one degree that's a challenge also for companies and their IR firms. But when you sort of did this, what were some of those things that spurred kind of your ideas, or shook your thinking, or got you to think about a company different? Was it like news, an acquisition? Was it really led by IR, or was it external sorts of circumstances that kind of facilitated getting your brain thinking about this opportunity or differently?
So I think every analyst goes about this a little bit differently, right? Every sell side analyst has their own franchise and they have their different specialties. Um, one thing I like to do a lot was to go visit private companies, right? I'm in the Bay Area. I can go up and down and see, you know, half the tech startups in the country. Getting to know them is very helpful and informative, um, because they may be competing with some of the public companies and have an interesting insight. I like to travel. I would go to China all the time. I have a lot of ties there, and so I'd go to see Chinese companies because there's things that are common knowledge there that aren't well known here, and there's an information arbitrage between the
Mm,
two.
mm-hmm.
Um, some people go to all the conferences. That's a really useful way to do it.
Yeah.
Um, but every analyst is going to be a little bit different, and some have surveys, some have a different tier. They talk to distributors, whatever. There's a whole way of doing it. The problem is there's never enough time, right? You think about the average
Exactly.
analyst covering 20 stocks. That means at least 15 days every quarter you have to be in the office for an earnings call. You have to be on the call, you have to write a note, like you can't be out seeing things. So already that's a big chunk of the year taken away. And then you start adding up, maintenance stuff and all the other pieces that sort of go with it. It's you're lucky if you have a day a week to get out of the office,
Right. Right.
right? Um, I think and then on top of that, I mean, in all honesty, another big part of idea generation comes from talking to the buy side, right? Because you're talking to you're a sell side analyst, you cover 25 stocks, you may talk to some hedge fund manager who is really doing a deep dive into one particular stock.
Right.
Smart person, they're going to have strong opinions and have good insight because they can often afford to hire outside experts and get new kinds of information. The problem with that is the buy side knows that and will absolutely game it,
Mm,
right? And so you'll every once in a while I get some fund manager call me up who I've never heard of before. It's like, hey, have you ever heard of this company, they're doing really crazy things. They're talking their own book, and
Right.
there's nothing wrong with that. You just have to be, as a sell side analyst, you have to be very aware of that process. It absolutely takes place. I will say that um, you you really don't want to be in a position where you're just writing on news, right? Because once the earnings are out, it's no longer,
Right.
you're not an analyst, you're a reporter. And
Right.
that's why everybody has a subscription to the journal. They can read the earnings results in tomorrow's newspaper. You have to have an opinion ahead of that to
Right.
really differentiate. And you'll see that some analysts, like, you cover 25 stocks, you're going to have your favorites, and you're going to have other ones that you just have to cover. You do maintenance coverage, and they probably only publish one note a quarter, which is right after earnings.
Right.
Um, so you don't want to wait for news. You don't want to wait for M&A. You don't really rely on IR much. IR also is very busy. They have the whole universe to cover, and so they're not good sources of inspiration for ideas typically. And that's there are pros and cons of that. You obviously, someone talking their own book, it's companies can talk their own books. You have to be careful what they say, but IR people, just that's not typically their function to provide good ideas. It's very hard for them. I shouldn't say it's not their function. It's very hard for them to provide good ideas in the near term.
So, one of the things I've sort of had conversations around, particularly with the buy side, is um, exercises that they can do to kind of reevaluate models. And again, this has to come from, like, you have a core thesis on an opportunity, or a company that you were looking has been stagnant for a while, and so it's sort of like I had a model, I had a financial model that's worked for X number of years. Um, do I, like, go through an exercise of, if I was to kind of recover this company today, what would change? What would not change? Would anything change? Would it be the same? Because, right, companies evolve, and what they were 10 years ago may or may not be what they are today, unless you're TI. Um, so elements of that, I think, are just, and I know time is not an issue, but I'm always curious, like, because I get some of those questions, like, what's changed? How should I think about things have changed? Are there metrics that I should care about that I'm not thinking about? Because again, I'm looking at this company through a one-sided or one-dimensional mirror.
So that's a tricky question to answer because we'd have to get into some very, very different constituencies among the buy side, right? And they're very, depending on the size and type of a fund, the the buy side fund manager is going to respond differently to that. Obviously, they all want to be proactive and thinking ahead and looking at things long term, um, but they all also have some very, very near term deadlines of their own, right? Hedge funds have to report every month,
Yep.
um, mutual funds every quarter, and there's certain sort of calendar dates that matter more than others and that sort of drive a lot of thinking. I will say that the really good fund managers absolutely do dedicate time to longer term thinking. They don't do it every day; it's not their biggest concern, um, but they they have all kinds of mechanisms in place to sort of evaluate those things. All right, and so I may have talked, there's fund managers who I'll talk to every week about what's going on in the market, what's the news, what do we think of this, what do we think of that, and then once a year, that person will give me a call and say, hey, what do you think about this long term stuff, right? Where is this company positioned in the sort of big picture? And honestly, I actually do that more now that I'm not on the sell side, right? I'll
Mm.
meet up with fund managers or PMs, and we'll have those kinds of conversations. Because again, like the sell side is really, really the mechanics of it really lend itself
Yeah.
to near term
Sure.
thinking.
Yeah. Well, and the other thing I like about the buy side conversations is, I mean, they see how their portfolios are being impacted in real time by a company who's doing really well or doing bad, or fundamental reasons why one particular company keeps returning them, X% on an annual basis. Whereas, the sell side tends to keep I don't want to say a rudimentary model, but something that's looking specifically at a growth sector, right? But they're not the ones seeing how money's being made or not being made in real time based on a name.
Yeah, I mean that's the tricky thing. Like, a lot of the buy side will just call up and get a model from the sell side.
Right.
Right now, maybe and some of them will make changes to it, and some of it won't. I think when investors are new to a company, new to a stock, they'll typically build their own model. They may start with some bare bones from the sell side. They'll build their own model, and some will go deeper. But for the there's a whole range of outcomes. I don't think nobody's sort of looking at the model. Well, I should say nobody, but for the most part, people don't look at their financial models and assume that this is providing an answer, right?
Right.
Oh, you have EPS out to 5 decimal places for the next 6 quarters. That's what I'm searching for.
Right.
That's,
Right.
when I used to train, when I was on the street, I used to train junior analysts, junior bankers. One of the things I'd always say is this model is not the answer. It's the purpose of the models. It's not to give you an answer. The purpose of the model is to show you what the constraints are in the model,
Mm.
right? Because people come up with these super detailed 500-row models that are mostly overkill. What you really need is, for the most part, for most of these companies, there's a few sort of revenue drivers, units, prices across a number of product lines. And then there's a few cost items, cost of goods sold, and then the operating expenses. Like that should be enough to tell you everything you need to know. You don't need to get into
Right.
super levels of detail, because as you add those layers of details, you're adding layers of assumptions and variability, right? The key thing is understand, like, oh, if the company is going to build this new product line and it's going to cost this much on R&D, how does that pan out over
Right.
3 years, right? Those kinds of
Right.
things.
Yeah. Well, and some of the metrics around like how does that impact their gross margin, and then do I believe that that's going to pay off, especially when you've got an increase in capex, etc. Like those are all, I think, interesting metrics to sort of hone in on. I mean, I have a lot of conversations around simplistic things because, again, semis is a relatively mature category, so we're not talking about somebody who's a hockey stick in growth, right? Like you would have in different prior builds. But there's the sort of broader conversations: who's undervalued, who's overvalued, right? And so you can look at what the multiples are and just sort of say, okay, is this going to lead to growth? Do I still believe they're undervalued even if their PE is 50, 60, 70, or are they undervalued at 8, 12, 15, based on their growth opportunities? So those are more conversations that kind of I hear around those models. But again,
Yeah,
simple metrics, but just trying to figure out where pockets of growth may come from in a non-hockey stick sort of market.
yeah. I mean, because that goes back to this condensing I was talking about before, where you have to boil down a whole company to a simple decision: do I buy or sell the
Right.
stock? Right?
Right.
And so you have your thesis, and then you look at the numbers, and you say, oh, this stock this company has a great product, and they're growing really nicely. That's the company. What's the stock look like? Well, the stock
Right.
is super expensive because everybody knows that all the above is true. Right? And so you, you have to condense that all down and make that decision based on those two things. And the model absolutely sort of provides you with that sort of financial backing. Like, oh, I find this a lot. Like companies will get really excited about some new product,
Mm-hmm.
and they'll talk it up to the street, and then the street will say, "Oh, that's great. I'm glad your widget is got such great specs, but it's only going to add a penny to revenue or a penny to earnings." Um, it, that happens a lot. That sort of that mismatch, and
Right.
I also think that one of the weird things for me from going inside a company was that most people don't look at the company from a company perspective. You're working inside a company, you have your job to do. You have to develop this product. You have to file this report. You got 6 meetings tomorrow, right? Looking at it from a very high level company perspective, there are very, very few people inside a company who are paid to do that. Most people are paid to focus on their specific job. And that actually, it's kind of this weird dynamic where it's the CEO's job to have that sort of company wide perspective, and maybe the CFO, but nobody else, right? And I always thought that was one of the ways I could add value or at least differentiate when I was working inside a company is as the you run IR, you hear what investors say, you hear their two sentence condensation of the whole company's thesis, and being able to communicate that internally is, it's not always well received, but
Right.
it's an important message.
Right. Well, and just broadly, and I'm making a massive generalization, but the thing that I've always found was super interesting about semiconductor companies is they typically generally operate as engineering companies. And so
Yep.
you get a lot of like, look how amazing this technology is, not tying that to rubber meets the road. You know, how does this increase our TAM or our SAM? How does this bring us into adjacency markets? And so, you know, I feel bad for a lot of these investors who aren't technical, who are like, well, look, I mean, don't talk to me like you're an engineering company. Like I need this story to land and make sense why I think, you know, you're going to make money and it's going to impact the stock. But that more than any other category, I feel that like engineering, you know, tech focus as a part of their posture, whereas other companies just do a really good job telling stories.
Yeah, I agree with that 100%. And this is something I've noticed for a long time is when people, you know, people in general talk about technology or definitely semis, the coverage you see in the press is it's one of two extremes. It's either incredibly engineering, detailed, down into the weeds with all the acronyms and speeds and feeds, and totally impenetrable unless you're an engineer in that field, or it's super dumbed down, oversimplified. Ooh, this makes the internet go faster. This is more secure. Like, and getting it somewhere in the middle where you understand enough of the technology and the trade-offs involved in those engineering decisions, and then being able to convey that strategically and say, oh, because we chose to go with this, therefore we can go after this market is very hard to do. But that's where the real value is. I mean, it's basically the idea I built my career
Right.
around is
Right.
being able to sit in the middle of those two and provide, you know, not too dumb but not too technical analysis.
Yeah. Yeah, and I think the root there just again comes from really seeing the market through that lens in a different form of analyst lens than a financial analyst lens, which is what we both can do. But taking that market approach, because you're absolutely right. Product announcements almost rarely lead to any significant like increase in a stock unless you're again Nvidia and you just saw, you know, made conversations about next generation GPUs and AI and your stock goes up, you know, 20%. But generally that doesn't happen. But I was also in a room when Jensen made a statement that he shouldn't with a bunch of investors and the
Yep.
stock declined like $20.
Yeah.
So
Yeah. I mean, Jensen Huang is particularly interesting. I mean, I think he's somewhat unique in the street is that he likes to talk about the big picture strategic issues,
he does.
right? He really does. And he's very good at that. He's both very compelling and he's very intelligent when he speaks about it. What I found is a lot of CEOs can either talk the engineering talk or they can talk the big picture stuff, but very hard for many of them to do both. And Jensen's really, really good about like both being able to talk about a big picture, but
Right.
I've never doubted that he understands like all the technical weeds of his product. Like he understands all the
Right.
technical stuff too.
Right.
The problem I think he faces is that he prefers to talk about the big picture stuff, and it sometimes gets him out over his skis. Once a cycle, it gets him out over his skis. But
Right. Well, and even though I appreciate and he's been the source of multiple aha moments for me in meetings I've had over the last 20 years, you also have to connect like that really big picture viewpoint, like you've said, to kind of the nitty gritty specifics. Like he's very good at that, using perspective or an analogy or a historical precedent about why this changed and why that matters
right,
now.
right,
It's sometimes really hard to see until many years after that he was even correct, right? But yet he's so wrapped up in like, this is such a big deal, why don't you see it, like you should understand. But I always find that interesting. But on this CEO point, I'm curious your perspective because we've seen in semis a number of companies who varying degrees of their highs and lows go through a CEO change. And I've always found it interesting how just some CEOs just have a like the street just likes them more than others. And sometimes it doesn't even really have anything to do with like the company being in a bad position. They just don't like the CEO. Like they don't get along. Maybe they just don't have confidence. I'm curious in your dynamic on Jensen's unique, right? He is one of the only still founders. But I even saw this not even in semis with Apple because it took some time for the street to embrace Tim after Steve. And there was times that Steve would have to come back on calls to help add his perspective because he was concerned investors were freaking out or the stock was starting to dip in after hours. And so that CEO kind of transition, I think, is really interesting in the relationship that executive team plays with their investors.
Yeah, I know that when I was an analyst, there was a new CEO announced, and if I didn't know him or her, the first thing I would do is look at their background, right? Where did they come up through the ranks? And usually in semis companies, they come through engineering, but
Mm-hmm.
sometimes they'll come up from the sales side of things. And I know that that's going to mean different things, right? You have to pay attention to that. And and if they come up from the CFO function, then I just walk away from the stock, but it's a different story.
Mm-hmm.
Um, on the flip side of that, I have found that CEOs generally do not like talking to the street. They don't dislike it, but it's a necessary evil. And because imagine you spent your career and you've gotten to the point where you're running a company, so clearly you're pretty competent. You've gotten a
Right.
lot of things right, and then you walk into a meeting in a tiny little cramped hotel room on some non-deal roadshow at an investor conference, and some 23-year-old a year out of Princeton is complaining to you about how you're running your business,
Yeah.
right? And
Yeah.
it's I think most CEOs just sort of put up with it. I think where CEOs tend to be very do best is when they do have some good relationships with the
Right.
street, with the buy side and the sell side,
Right.
where there's they're not going to like everybody, but they have a few people who they can rely on and talk to regularly. Like I once worked with an analyst, and he was covering a different sector, but CEOs would call him up and ask him for advice,
Mm.
right? And I always thought that was like that's sort of like that's rare. That's a good analyst. And I think the CEOs that just sort of just grit their teeth and put up with the street for
Right.
a brief period of
Right.
time will always are always going to struggle. As they don't
Yeah.
have to, you don't have to like everybody, but having a few analysts who or a few fund managers who you have a good relationship with can mean a lot because they can typically, again, the buy side is pretty smart, and they
Yeah.
good fund managers can provide good insight. They're not always right,
Right.
but
Right.
there's something
Right.
there.
But I mean, you're absolutely right, and I've had this conversation with a number of big tech CEOs who I know share that opinion that you just outlined. Their focus, and rightly so, when growing and building a business, is always on their customers. And I've always tried to say like that's super important, but you kind of also have to view investors as your customers. They might not be buying your product the same way, but they're buying, right, essentially your company. And to have that viewpoint of just how important it still is. Yes, you talk to them differently. Yes, you communicate vision, but that's still taking a customer centric approach, and it just happens to be towards your investor community, not just those who are buying your products or your services.
Yeah, being a CEO can be a tough job. I mean, I don't want to feel too sorry for them. They get paid well, but there's you have to balance so many different constituencies.
Yeah, you
And
do.
I think the tendency is, in some cases, yes, it's to your customer to sort of favor your customers as sort of the first person you call in the day. Other people, it's your employees, like specific departments who you sort of favor. But you have to balance the employees and the company bureaucracy and your customers and the street broadly defined. And then on top of that, you have to manage the pack of feral cats that's your board of directors,
Yeah.
right? There's a lot of challenges in that, and I think it's just human nature to sort of prefer one group over another and rather spend
Yeah.
time with one over the other. And that's okay, but I think where CEOs get in trouble is when they over favor one to the expense of to the you know to the at the expense of others entirely.
Correct. Yeah, I agree with that. And it's interesting too. I mean, I tend to feel like we're at this point in technology. I mean, I saw this tweet the other day and I thought it was super interesting. I retweeted it where, you look at past growth stages of technology. Um, were hockey sticks because we were bringing new people, humans or businesses into the digital age. And not to say that every human is now connected or every business is fully embraced in digital, but the hockey stick I think looks a little bit different towards sort of markets going forward, right? It's not like we're going to, like automotive's a good one. It's not like we're going to sell particularly more cars. We're just selling different cars. So yes, it's a gigantic opportunity for semis, but we're not bringing on new buyers, right? We're not bringing new people to the internet or new people to computers or new people who didn't have smartphones, which were massive hockey sticks. So looking at this as a somewhat mature kind of category I think is a new challenge for investors and for investor relations. I'm not saying there won't be things that happen hockey sticks in the future. I'm just saying if you just look at what's on the short-term horizon, you got to handle this differently when you're looking at either share taking from a vested party or areas that are, again, the volume sales, you're just putting up an increasing BOM cost that goes to semi as a part of share of wallet of a product. But I just think it's interesting. Like, I wonder if we're in this kind of new approach, right? New approach to from how investors think about this, but maybe even more importantly, new approach on how IR has to think about this in terms of both mind share, the opportunity, because I do feel like we're in a very different period than kind of the last 20 years when it came to accelerated growth cycles.
Yeah, I think I think it's a big problem because across the industry, because a lot of people who are CEOs today came up in the ranks during the PC boom and the internet boom, which were
Mm,
fundamental changes in just access to information. And then there's another crop that came up during the smartphone boom, which was equally impactful. And I know after
mm,
sort of in the 2010s, there was definitely this unspoken sense among investors that we're just sort of looking for the new thing. And I think that explains a lot of the hype around AR and VR. We're all looking for the
right,
next
right.
big thing, and that may not arrive, right? And maybe it'll be cars, maybe not. But we shouldn't depend on it because while that was taking place, the industry absolutely matured. It consolidated down radically, and I think understanding that, I think a lot of investors today are very disciplined, and they're not necessarily looking for the next big paradigm shift or disruption or innovation or whatever the big words are. They're looking for much more practical, tangible things. And you're right. I think that that is something that investor relations teams have to come to grips with, is to understand that sort of fundamental mindset of what most investors are thinking and adapting their communication strategies accordingly.
Yep. And within this vein that we talked about, which is that nobody has enough time to really cover them. So like you really have to do the work to help handhold to some degree part of their thesis, part of their concerns, part of or justify, their beliefs, right, with what you've got. So you've only got so much time to do that. You can't cover everything. And so there's more impactful ways I think companies are going to have to deal with this, recognizing that you've got to do more work for again these customers who are essentially buying your stock.
That's right. And I think there's a whole playbook of ways to get companies interested, get analysts interested in your company and your stock,
Sure.
and then how to communicate to them what to talk about, what not to talk about, how to frame answers,
Yeah.
how to walk through Q&A, how to present. There's a whole list of things that can be done, that do not necessarily get reflected every day because there's an infinite workload in a lot of these investor relation jobs.
Yeah. No, I totally agree. All right, interesting stuff. I could talk about this all day from an investor perspective, and even micro minutia, little nitty gritty tickers might be fun at some point. But I'll leave it at that. Good conversation. Hope everybody has a great weekend wherever you're listening to, and we will talk to you next time.
Farewell.